Welcome back. Well, the market is now still under pressure. It's not getting any worse, but it's not getting any better either. The Nifty is down about 140 points. Couple of stocks do deserve mention, though. Once again, the PSU banks are coming back in a big way. So despite the overall market under pressure, despite the Nifty bank under pressure, look at names like Bank of Maharashtra, UCO Bank, IOB, all up anywhere between 3 to 5%, and volumes also picking up. So this is clearly the traders' favorite and continues to be so. One stock that we're tracking right now is Endurance Technologies. That company has reported their numbers mixed bag. The revenues were strong, a 25% growth, but once again, the margins are where the pressure is at. It's down 220 basis points versus last year because of higher metal and energy costs, especially in a market like Europe. Ramesh Gehani, who's the Executive Director and COO of Endurance, joins us now. Mr. Gehani, good morning. The story has been the same for so many quarters now, right? High energy costs in Europe hitting companies like yours. But tell us, has it gotten any better compared to when we spoke last, in Europe particularly?
Yeah, good morning, Sonia. That's a good question again. But let's not forget, see, the auto industry has been suffering since the past 8 quarters as far as the volatility is concerned. But if I talk about Europe, yes, they've been they continue to be under testing times. But let us look at the green shoots now. Earlier, what I told you that the gas prices and energy prices are not being recognized by the OEMs. This time, I've got to say that yes, they are recognizing that, and we've got some very good meetings. We had some very good meetings with them, and we can look at better quarters ahead. That's number one. Number two, the EU market or the EU industry is just about better by 0.4%, whereas Endurance has gained revenues by 25%, which is a very good thing to happen over there. This is primarily coming because the kind of orders that we had procured in the previous years are now maturing out, especially in the EV space. We are actively winning new businesses. I can tell you about this quarter also, or this first half, we've already won 42 million euros of business, in addition to what we had earned last year, which was 72 million. So I think things are getting better, and recognition towards our also coming into play. Our previous business wins are also coming into play. So let's hope, apart from this Ukraine thing, which still is holding, the recalibrations being done by the OEMs and by the tier ones do play in a role, and things get better from here onwards.
When you say things are getting better, on the margin front, you're reduced to now just about 11.5% margins. You think you can get back to 13-14% in this fiscal itself, or is that a tall ask?
See, I don't see any reason why we should not be reaching to those levels, for a simple reason that now commodity prices are coming down. We know that the previous balance sheet, or the H1 has got an impact of commodities and commodities on the balance sheet. Now the prices are softening, especially aluminium alloy. So if that comes down, you'll see an arithmetical difference and an optical difference on the numbers as far as the margins are concerned. But otherwise also means we are getting into a better model mix, and that's what our key strategy has always been, to get into a new model mix where mixed models give you more revenues and higher margins. So this is what we are aiming at, and I think we are working well on our strategies. I see no reason why we can't get back to previous numbers. Here also, if you remove the commodity price inflation index on inflation on the balance sheet, you'll still find that our margins are pretty well stable and decent enough.
So, let's talk about the good part, right? We keep talking about the European business, which is under pressure, but there's an India business as well, which is a larger chunk, and that's doing fairly well. I mean, you had new orders worth 700 crores that you added in the first half of the year. Is this a run rate that you can maintain in the second half? Where are these new orders coming in from? And what's the visibility like for the rest of the year?
Okay, let me give you a flavor. As you mentioned about new orders, last 5 years, I was just looking at the numbers this morning. Last 5 years, we have won businesses close to 5,000 crores. Now, obviously, the revenue increase is coming from the business which is maturing out over there. 700 crores of orders booked in this year is a very positive sign. That means new businesses are walking their way towards Endurance. And primarily because, the configuration of the vehicles are changing. We have won major orders in brakes. We've got die casting orders, which we are getting into high-end machining and big castings from our customers. So things on new business wins, I think we are doing very well, even in the space of EV, where we started a bit late as far as our engagement process is concerned with the OEMs. But now we are pretty much on track, and we've already won businesses close to 600 crores. So there are two segments which are moving forward, and we are just on track.
Okay. I just have a couple of more questions on the order wins, but before that, lest we run out of time, on Maxwell, I wanted to understand the recent acquisition. 51% has been acquired. When do you plan to acquire the rest? And what are the synergies that you're expecting? Anything in this fiscal itself?
Yes, again, a good question. See, we have acquired Maxwell with a formula-based and success-based acquisition. We have paid somewhere around 135 crores in the first tranche. The total acquisition is going to happen in 5 years' time. That's on steps, and we are completely engaged with them on new business wins, and how do we synergize and how do we integrate with them on electronics and embedded systems. Now, embedded system, that this is the name of tomorrow, where probably everything on the vehicle will be talking through ECUs, and electronic will play a big role. We've got close to 100 people working in Maxwell, and we'll be leveraging all those strengths where they know pretty well how to write the algorithms and understand the electronics of it. We're also setting up new manufacturing lines at Aurangabad, and they should be in operation by April 23. So I think it's getting on along very well, and we are on track as far as the integration is concerned.
Okay, just a quick last point, because you have mentioned a lot of positives. You're looking at better quarters ahead. You're saying that there's no reason why you can't get back to 13-14% margins. So is it safe to say that the worst of the pressure in the European business is now behind Endurance? Because it's been a long 7-8 quarters, right? As you mentioned that you've been going through this ordeal. But do you think the worst is over?
Well, see, as an individual, I'm an optimistic person, so I don't say that nothing is going to be staying for long. Things are challenging. When I talk in general public, there are still fears which are looming around. The uncertainties are still playing around. But as I said last time, everybody recalibrates themselves to the fresh challenges, and this is exactly what is happening over there. If we've been able to win businesses from all our OEMs on EV space and otherwise, close to 100 million, 42 plus, 42 plus 72, 112 million euros of business. That's a positive sign moving forward, and I see no reason why we cannot be adding up to these revenues. Secondly, the new acquisitions that we've done, they're clearly in the space of aftermarket. That means we want to grow our aftermarket business also over there.
Right. All right. Thank you very much for joining us. It's a pleasure, sir, and good luck with that view. I mean, it makes sense to be optimistic and kind of, look for things to get better. 1513 on Endurance is what we have. But PNB Housing Finance is the next company on our radar. This is, after the conference call, the management has said that they will focus on growing the retail book with an aggressive, affordable focus and bringing down the corporate book. Mr. Girish Kozgi is the new Managing Director and CEO at PNB Housing Finance. He took over charge exactly a month ago. Mr. Kozgi, it's a pleasure having you with us here in your new avatar. Good morning, Prashant this side, and congratulations from all of us here. So straight off the bat, Mr. Kozgi, you've kind of upgraded, what PNB Housing as a business will be able to do in terms of loan growth, in terms of dispersal growth, spreads. With you being there a month now, I mean, how confident are you that some of this is going to be achievable? And if you can also lay out slightly kind of longer term, 2-3 year kind of plan. PNB Housing is also a company which has got significant private equity investors, so they would have also kind of spoken with you. And how's the vision looking at PNB Housing with the new management in place?
Good morning. I think it's exactly a month that I joined this great institution, PNB Housing. I think going forward, our focus is largely going to be on affordable. So today we are about, let's say, 90% on prime, and the rest is affordable. So going forward, incrementally, we would do affordable 25%, and over a period of time, we will try and increase that share. So in terms of guidance, I think I had mentioned in the investor call as well, we will be looking at about 40% growth on disbursement over last year. And in terms of book growth, it will be close to 10%, maybe 8% or 7%, or maybe even 9%. I think from next year onwards, we'll be able to grow disbursement in the range of 22 to 25% for next few years. And in terms of book growth from next year, we'll be in the range of 17 to 18%. I think this is the guidance. we see that market is quite robust. And in PNB, this slight change in strategy will be pretty aggressive on affordable. Just to give you some data point, I think before end of this financial year, we will have 80 odd exclusive affordable branches, which would focus on a ticket size of about 15 to 16 lakhs kind of a segment. I think that's our focus. In terms of vision, we would very soon want to hit 1 lakh crore book.
Okay, so this 24 to 24% growth that you've seen in the retail business, Mr. Kosgi, I want to just talk a little bit about that. By the way, congratulations, you've completed 1 month and hopefully you have a long journey ahead. Within the retail book, there's a sharp drop in business with self-employed individuals. Is that a strategy that the company has undertaken, to reduce the exposure there because of perhaps higher NPAs? Just give us a little bit of understanding of how this is playing out, and is this just an aberration?
No, I think it is more by design, even though we've just started that. I think going forward, our salaried share would go up in the mix. Self-employed would come down because it's a well-known fact that self-employed would have a slightly higher delinquency compared to salaried. So our focus is going to be on salaried. Having said that, we will also continue doing SNB business. In terms of mix, there'll be a slight change. So probably I would put a number going forward, let's say 70 and 30, or maybe 65 and 35. So we want to have salaried between 65 to 70%, and the rest would be SCP and SCNP. In terms of prime and affordable, I've given. In terms of margins, I think for next few quarters, spread would be threshold of 2.2 and NIM would be 3.2. As of now, you will see it's on the higher side. There'll be a lot of fluctuations, but I think on a steady state business, long term, we would protect 2.2 and 3.2.
Okay. Hi, Mr. Kosgi, and congratulations on your new role. What about credit cost? Could you give us a guidance out there?
Our focus is now largely on retail, and we know that we have to bring down our delinquency. We are working on retail very, very aggressively, both in terms of growth, when we talk about growth on disbursements, on book, and we also want to bring down delinquency. In terms of credit cost, it will be in the level what we saw in H1. H1 was about 0.92%, so you will see it slightly higher. I think very shortly this will get normalized. On the corporate side, we have a book of 5,700 crores. There, the focus now is to bring down delinquency. So we are not keen to start the business. We will take about time. We'll take about 3 to 4 quarters. We'll bring down delinquency, and then we will restart. So our focus also would be there on corporate, but going forward, probably in a different format altogether. Lower ticket size will be present more on a strategic level. But yes, that would happen once we bring down delinquency in the corporate book.
Any fundraise, Mr. Kosgi? Would Carlyle increase their stake? I know it's still early days, but anything you can tell us at this stage?
I won't be able to comment on that. I think as a company, we focus on operations. We try to
for the company, any fundraise?
Better quarter after quarter. In terms of various stakeholders, I think it is their call and decision.
Right.
I would not be able to comment on that.
Any fundraise? Any plans to raise any funds with these higher growth targets?
Yeah, we are planning for growth capital. So we are planning for rights issue, which must get...
Which you had guided. Okay, all right. Fair enough.
Yeah.
Fair enough.
Okay, Mr. Kosgi, thanks a lot for joining in and all the best for the future. By the way, those are the 2 new listings today. The one that's expected to be cracker is Archean Chemicals. In pre-opening, actually, it's a 12% run that Archean Chemicals is having. There you go. There's a listing 13% higher on Archean Chemicals. As we were telling you earlier, it was expected to be a very good listing. It saw over 32 times subscription. It is the largest exporter of bromine and industrial salt by volume in India. So the fundamentals are quite strong. And compared to a lot of its peers as well, it's relatively better valued. It's also a very strong entry barrier business. So, lots of things working in Archean Chemicals' favor. 5-star business, that's the other one that's had a muted listing, but it was expected to be muted. The subscription was also hardly filled. In fact, it was just 0.7 times subscribed. So these are the 2 new listings. The one that's taken it away is Archean Chemicals, undoubtedly.
Okay, all right. Well, let's get to our next management. We have RHI Magnesita will acquire the Indian refractory business of the Dalmia Group for around 1,700 crores. They'll also be pulling in some debt in their books. Well, to understand this acquisition and to find out what they want to do with this acquired asset, how they want to ramp it up, we're joined by Mr. Pramod Sagar, the MD and CEO of the company. Hi, Mr. Sagar. Well, I reached out to you a couple of times. Now I know why you were on silent mode, because this deal was in the works. But let's talk about this acquired asset first up. What is the current utilization levels? I saw for the last year you did around 950 crores. So at optimal levels, what kind of a revenue can it do? And also margins are only 10%. You must be having a plan to bring it up, right, to mid-teens like how RHI is currently functioning at. Give us a guidance on both these two numbers.
Hi, good morning, Prashant. As you rightly said, yes, the utilization as of now is around 55-60%, and we will definitely be ramping it up. And margin as such will also go up, and we will do some modernization. And I think margin will be at our average level of 15-16% in coming days.
Incoming. So, Mr. Sagar, actually, this is Nigel on this side. Prashant will get to you in just a bit. Yeah. So your margins, you're saying you're going to get to 15-16% by when? By FY 24, 25? When does that happen? And also just plugging in the numbers, 55 to 60% capacity utilization levels is what you're functioning at. So this acquired asset at full, utilization levels can do around 1,600 crores approximately?
Absolutely. You're right.
1,600 crores of revenues and margins go to 15-16%.
15 to 16%.
Which year?
24, probably.
24.
Okay. Also wanted to understand, post the acquisition of Dalmia and High-Tech Refractories business, what does the market share of RHI go up to?
I think 33-34% probably.
Okay. What was it earlier?
Before taking over High-Tech, it was 22, and after High-Tech, it is 24.5 or so, and with this, it will reach to 33-34%.
Okay. All right. So it's going to 33%. So clearly, you're being a little aggressive, and you're paying top dollar also, 22 times EV upon EBITDA, which is fine. But your debt number, sir, is likely to go up because the High-Tech acquisition, that was for around 600 crores. Now you're taking around 400 crores of debt in your books. Earlier, you were debt-free, I think so, and you had some small cash as well. So what was the last reported cash balance, if you could tell us? And post both these two acquisitions, what does your debt number go to?
Cash in bank, it was around 100 crores, and with this debt, it will be around 1,300 crores. But still, I believe it will not have a serious impact on my debt. That equity ratio will still remain 1:1 or so.
What does the peak debt level look like? You said 1,300 crores.
Yeah.
How is that, sir? Because you had 100 crores, 600 crores you're paying for High-Tech. Here you're assuming 450 crores. Do you have some more capex plans? That's why it goes to 1,300 crores?
Yes, we have kept 200 crores roughly for modernization of Dalmia Bharat refractory business.
Oh,
okay. 200 crores, all right.
But it will be spent in next 4 or 5 years' time.
Okay, so 200 crores capex over the next 4 to 5 years. This is, of course, assuming that, there is a good growth in the overall business as well. Hence, you're putting more capex on board, I'm sure. Can you tell us a little bit about the demand situation? What kind of growth are you expecting? And what could the sustainable margins be for the business in the medium term?
We believe that steel industry will keep on growing at 7-8% CAGR in coming 6-7 years' time. And cement will also be doing well. We think, what was your second question, sorry?
The sustainable margins for the business.
Sustainable margin, but I keep on saying, I think we will sustain it at 15-16%.
Okay, all right. Very quickly, Mr. Sagar, the Dalmia Group, you have issued them shares, right? So they'll be owning a stake in the company. Is there any lock-in out there? Because from your shareholder perspective, they'll be worried at some point of time Dalmia may want to cash out. So is there a lock-in or are they free to sell?
Yes, there is a lock-in period also.
For how long?
I think 6 months.
For 6 months or so. Thanks so much, Mr. Sagar, for joining in. You've given us a fair bit of details. The capacity utilization of the acquired asset is 55 to 60%. At peak levels, it can go to around 1,500 crores. The peak debt levels will be around 1,300 crores for the company. For the time being, though, that's one of the outperforming stocks, up close to around 4.5%. Slip into a short break. You come back. Mitesh Thakkar will be joining us on the other side.
Okay, welcome back. I mean, the big question for the market is whether, this is a dip that you should attempt to try and buy, or, let it trade and tell you which way the market is going before you do something. Mitesh is here to tell us exactly that. Mitesh, what's your sense? We're still down 140 points in the Nifty.
Prashant, I think, we talked about this, that our belief is that we might actually test 18,100, and in the worst case scenario, even 17,980, 18,000. This looks like more of a anti-trend or a corrective kind of a pullback happening on the indices, which could be deeper than what we have seen in the last few days. So I think we'll still wait it out. I think closer to about 18,000, 18,020, you would want to see some strength coming, so another 100, 120 points could happen on the downside before we actually want to venture strongly on the index buying side. Till then, I think trading with more of stock-specific bias, I have a sell and a buy right now. Wipro is a sell with a stop at 394 for targets of 380, while Shriram Transport Finance, and that's a stock which is showing exceptional strength and a bullish chart setup as well. That's a buy with a stop just below levels of 1270 for targets of around 1330.
Okay, thanks a lot, Mitesh, for that. Have a good one. Let's move over now to the big headline, which was in the world of crude and that massive slide that we saw. Manisha Gupta is here to talk about the commodity market. Manisha, what's the one commodity you're looking at today?
So now I'm looking at the crude oil prices because the decline that we saw in the previous week seems to be getting extended in this week as well. So we've opened Asia more than 1% on the lower side for both the crude varieties there. This is what the crude prices did in the last week. Nearly 10% of a cut is what we saw. The week prior was 3 to 4% of a decline as well. And the last 1 month has seen 6% of a cut coming in for the crude oil prices. So we have turned negative on the month-on-month basis into this one as well. It's a 2-month lows coming in for the crude prices. And from the high of November itself, where we did see Brent prices hit a high of $98 a barrel, we've come to 86 on your screens here. The major reasons clearly have been the US dollar index, which has seen a strength of 0.5% in the previous week and is trading in the positive in the Asian markets today as well. The Chinese COVID cases have continued to rise. 23,000 was the count that we saw in the previous week, which is the highest since the month of April. The demand continues to be on the weaker side. November was a weak number, and China has gone ahead and cut the December loading values or volumes for Saudi Arabia. So that tells you that they have enough inventory at hand, and they are cutting imports for the month of December going forward as well. So that futuristic month also seems to be weaker. And then Europe also which has had supply concerns, but now the refiners have piled up stocks. Europe's target was 80% of stocks to be filled, but they are anywhere around 92 to 95% on the higher side. So that also has led those concerns of the prices there. Not just China and Europe, you have concerns coming in from US, where the manufacturing activity for the month of October was the lowest since 2011. So various views, various cues, the reason that you have seen the crude prices continue to decline there. But what the market will now watch for is the OPEC and allies meeting, which is on 4th of December. They would be reviewing the production policy, and the expectation that with the kind of decline that we have seen in crude oil prices, there could be some important, consistent statements coming in from OPEC and allies. So while the OPEC meeting is on 4th of December, on 5th of December, you'll be watching out for the European and G7 price cap on Russian oil. Markets are anticipating that to come in anywhere between $65 to 72 on the higher side, but that's a number that we still are awaiting.
All right, Manisha, thank you very much for that. That's oil. It's going in the right direction for us, at least, in terms of macros here in India with all the import bill. We'll take a quick break here. On the other side, our special segment, it's the economy. My colleague Lata will chat with S.S. Mundra, former RBI Deputy Governor, and Sunil Mehta, Chief Executive, Indian Banks Association, to discuss the recent announcement of allowing appointment of PSU bank heads for 5 years and further extendable by another 5 years. Stay with us.